Afternoon, everyone. Thank you for coming along to what looks like it's been a really great event, actually. As Annabelle said, I'm going to talk about UK equities being cheap this afternoon, and I suspect most of you have kind of heard that story probably a dozen times before in the last couple of years. But the good news is I'm going to give you two catalysts that I think are going to realise that value. So let's jump into it. I'm going to start with this quote from a well-known value investor in the US called David Einhorn. David Einhorn said recently, the market is dominated by investors that either will not, index funds, cannot, untrained novice investors, or choose not to, valuation indifferent professional investors, have valuation as a cornerstone of their investment process. And Nick Purvis and myself, who run the Temple Bar Investment Trust, that's exactly how we feel. We feel like there are a very small number of us left in the world who still use valuation as our sort of our cornerstone of how we invest. The bad news that we have in the UK that David Einhorn doesn't have to deal with is this. This is yet another attempt to sort of basically destroy our pension system. In around about 2000, we came up with a new accounting standard called FRS 17. I'm not going to go into too much detail because it's very boring. But effectively, it was mark-to-market accounting for pension funds. And it caused an enormous change in the behaviour of people who manage pension funds. The green bit at the bottom there is UK equities. And if you can see the scale, in 2000, a UK pension fund would have about 55% of its total fund, not just its equities, invested in UK equities. And that figure today is 3. The light blob at the top, that's bonds. So what we did was we forced an investment behaviour on pension funds in which they sold UK equities irrespective of how lowly valued they were, and they bought bonds irrespective of how highly valued they were. So this is what we've referred to as valuation agnostic selling of UK equities. The good news is that for us, that's good news. When you have other people irrationally selling something because they've been told to by a regulator rather than because they're taking a fundamental valuation signal, that's good news for the rest of us. Now, if you only take away one thing from today, it would be this. And this is the message of this chart is that in the long run, we should look at valuation because valuation matters. What you're looking at here is 100 years of data of the US stock market. Across the x-axis, we have valuation. So this is a market cap to GDP type of valuation measure, cheap on the left-hand side, expensive on the right-hand side. Up the y-axis, we have the annualized returns that you got when you bought the US market on those different valuations. Probably the easiest way to do this is to give you some examples. So if I ask you to look at 0.5 on the x-axis and then take your eyes up to where the blue dots are. So when you bought the US stock market when it was cheap, you made about 18% per annum returns for the next 12 years. Not bad. Go to 1 when you bought the US equity market when it was fairly valued. Funnily enough, you got long-run average returns. You got about 8 to 10% returns. Now I'd like to ask you to go to the far right-hand side where that little arrow is. That's where we are today. So if that data holds, you should expect to lose 4% per annum from investing in the US equity market. And when I say if that data holds, the R squared, the correlation of the sequence of data, is minus 0.93. That is a pretty good correlation. So anyone taking a big bet on the US equity market, you're effectively saying that this time really is going to be different and that data is not going to hold in the future. Okay, so we know the US is expensive and we know that valuation works in the long run. So what's cheap at the moment? We would say UK equities are cheap. The chart on the left-hand side here, again, this is a 50-year chart. And it's the valuation of the UK equity market relative to world equities. And the average throughout this period is about a 17% discount. So the UK is always a bit cheaper than the world market, and that's because of index composition and all those sorts of things that you know about. Today, we're at a 45% discount, so a much, much wider discount than we used to be at. And if we look at the chart on the right-hand side, the chart on the right-hand side basically looks at the valuation of UK sectors versus their US peers. And what interests us about this is even if you are crashingly bearish on the UK economy, if you look at global sectors, so take something like the energy sector, BP and Shell are not dependent on the UK economy, and yet they trade on half the valuations of their US equivalents. So BP and Shell trade on about 6 times earnings, Exxon and Chevron on about 12 times earnings. So, something very strange going on there. So, as I said, I think you probably all know that, that we think UK equities are cheap, which is fine and dandy, but, what are going to be the catalysts for the realisation of this value? Well, this year, the good news is there's 2. The first one is corporate takeovers. The chart you're looking at here is basically the number of takeovers of UK companies by year. We've got, the last 10 years here. You can see on average, this has been about 40 companies get taken over every year in the UK. Last year, that jumped up to 64. And this year, it's jumped up again. So the run rate this year is much, much higher. Year to date, within Temple Bar, we've had four bids for companies that we invest in. We've had Currys, Anglo American, Direct Line and IDS all bid for. The only live one there at the moment is IDS. But the point to take away from this is corporates actually realising that the valuations of UK equities are just crazy. And so if you're a private equity firm or if you're a US corporate, you can come in and buy these things and they, at very, very low valuations. And this is not just investors punting a few £100. This is corporates spending billions on these takeovers. So I think that's kind of point number one. This validates this idea that UK equities are cheap, and it's a catalyst for the realisation of this value. Catalyst number 2, which I'm going to focus on today, is share buybacks. We're quite big investors in UK PLC, therefore we get good access to the companies. And I can tell you they've been a pretty gloomy bunch for the last couple of years because they come in and see us and they say, what's going on? Everything feels like it's going pretty well. My business is going well. Why does my share price do nothing but go down? Why am I sat here on a P of 5 and a dividend yield of 8? And we say to them, look, don't take it personally. It's not you. It is just this valuation agnostic selling of UK equities that's been going on. But rather than get angry about it, why don't you use it to your own advantage by basically buying back your own stock? Because if you buy back your own stock, there's pretty much nothing that adds more value to your shareholders when your shares are that cheap than buying back your own stock. And the great news this year is that message seems to have got through. And that's what we're showing here. So if you look at the top line there is the number of UK companies that have bought back their stock in the last year, and that line recently hit 50%. So half of UK companies have bought back their own stock in the last year. At one stage, that was about £1 billion of buybacks going through the UK market, companies buying back their own stock. Right, I'm going to give you literally sort of 2 minutes of the sort of academic background to why buying back stock matters and adds value. So put your phones down. I want you to imagine a company with a market cap of £1 billion, and that company generates £100 million of free cash flow. Okay, that's all I want you to think about. And let's just say it takes that £100 million of free cash flow, it pays 50 out as a dividend, and it uses the other 50 to buy back stock. So the number of shares in issue go down by 5%. The total return from that business, assuming nothing else, we're not assuming any growth, any change in rating, is 10%. So, a little bit better than the long-run average equity return, just from paying a 5 dividend and buying 5 of stock back. Let's go to the company in the middle, same company, billion market cap, with 100 million of free cash flow, but this time we're going to say that 100 million of free cash flow actually grows. I mean, to keep the numbers easy, we're going to say 5%. So now you've got a 5 dividend, a 5 share buyback, and 5 of growth. So that's getting you to 15. That's a pretty attractive return. Company on the right-hand side is exactly the same, but this time we're going to assume a bit of a re-rating. So it starts this period at a 10% free cash flow yield. By the time we get to the end of the period, investors have decided, actually, this is not such a bad company. We're going to put it on a 6% free cash flow yield. You're now looking at a 24% per annum total return, which is, I think we'd all be pretty happy with that, wouldn't we? The really cool thing about this is that it doesn't just work in theory, it works in practice as well. So let me give you a couple of examples. This company here, you will know, this is Next PLC, the retailer. And this is just a fascinating story here. The business is an okay business. It's not an amazing business. So if you look over on the left-hand side, we're looking at the period basically 2000 to today. Its sales have grown by about 5% per annum. So roughly in line with UK GDP, a little bit better. The share price on the right-hand side, that's gone from, that was £3 in 2000. It just recently went through £110. And you might think, and by the way, that return across that period of time, that is about a 16% per annum total return to shareholders. You might think, how can a company growing its top line at 5 give its shareholders 16% per annum total return? The reason is that Lord Wolfson, the boss of this company, has bought back, believe it or not, 2/3 of the shares in issue over that period. So there's now only one third of the number of shares in existence today that there were back in 2000. And if you just think about that mathematically, even if your sales and your net income are not growing, your earnings per share and your dividends per share are just mathematically going to grow faster, aren't they? Because you're shrinking the number of shares in issue. And you can see here, the EPS has indeed grown by about 13% per annum. This next one, I find this even more remarkable, actually. This is British American Tobacco. And again, if we start with the share price on the right-hand side, so 2000, share price is about 3. 2015, so just in 15 years, share price is £50. That's an annualised return of nearly 24% per annum that you got in that 15-year period. Now go and look at the sales growth. 1% per annum. So in 2000, people didn't like these sorts of companies because they loved tech, just a bit like today, and they hated anything that was classed old economy, and nothing really was more old economy than tobacco. The funny thing is they were sort of right, weren't they? Because sales only grew by 1% per annum over the next 15 years. And yet, the company gave its shareholders a 24% per annum total return. How? Exactly the same as Next. They basically paid out a dividend, they bought back stock, it's a cash-generative business. And again, you had a bit of a re-rating. So people hated it in 2000. By the time we get to 2015, actually people didn't hate it so much. So I suppose my key message there is that I think people underestimate the power of share buybacks. It's not nearly as exciting as the growth potential from AI, but it can generate some extremely positive returns. Okay, so coming back to the UK, why is the UK in a sort of, I suppose, a good spot at the moment to be able to do this? It comes back to this subject of valuation. Because we've had this valuation agnostic selling of UK equities for so long, you look at the starting valuation of the UK. So what I'm looking at here is I'm looking at what I've described as total yield. So it's the dividend yield, and then I've added on the buyback yield, for the UK market. And the UK is the highest in the world today. So 6% versus about 4% for Europe, and versus less than 3% for the US. So we are starting with an advantage of having the highest dividend yield. And as I showed you earlier, the UK is now the market in the world that is buying back the most stock, higher than any other market in the world. So that's a good start place. Okay, let's now sort of take this down to a company level and talk to you about why we think that, I suppose, what's happened with Next and BAT from the period of 2000 onwards can potentially happen to some of these other companies today. And what we've done here is, I hope you can see those numbers. I hope those are large enough. We've got some companies that are held within the portfolio, some energy companies, some banks, some insurance companies, etc. The first column I've called 2-year earnings per share yield. And what that is, it's the earnings per share that these companies actually have generated in 22 and 23, added together, divided by the market cap or the share price, okay? Just look at some of the numbers. So, in the energy companies, we're talking sort of 30 to 40% of their market cap they've generated in earnings in 2 years. Look at the banks again, similar sorts of figures, 30-odd%, ditto with the insurance companies. Next column across is now starting to look at what have they done with those earnings. So this is the dividends per share that they've paid out in 22 and 23, divided by the market cap or the share price. And again, we can see sort of figures of 10-ish% that you've been paid out in the last couple of years. Go across to the next column, and this is coming back to my focus on share buybacks, how much have they bought back in shares of their market cap in 2 years? And again, just some of these numbers are extraordinary. 20-odd% for the energy companies. They bought back a fifth of their shares in issue in 2 years. Look at the NatWest figure there, 30%. So they bought back nearly a third of the shares in issue in 2 years. I said to you earlier on, Next has been so successful because it's bought back 2/3 of its shares in 24 years. Well, NatWest have done a third in 2 years. And hopefully you can sort of see the picture there. And the final column just adds the two together. So it adds dividends and share buybacks together to tell you what you've been paid back in dividends and share buybacks in 2 years. And again, some of those figures just remarkable, kind of 30 to 40% type figures that you've been paid back. Now, the interesting thing about this is that you can go through long periods of time when this sort of doesn't really matter to people. It's just not that exciting. But eventually it does catch up. And the reason it catches up is when you are shrinking your share count that fast, unless your profits are collapsing, your earnings per share and your dividends per share start to go up pretty dramatically. And Temple Bar has had a pretty good year in the last year, and some of the biggest drivers have been some of these companies. So NatWest and Barclays both up around 50% year to date. So the market is starting to take notice. And of course, not only does the market take notice, but other companies take notice. So when other companies within the sector see the share prices starting to react like this, it encourages them to copy that behaviour. Again, I suppose this is just an example of what I was talking about a minute ago, of how often these share buybacks can do nothing for a long period of time, and then all of a sudden, for no particular reason, the market just wakes up to the share buybacks. And so this is a US company called Dillard's. Dillard's is a department store in the US. It's a very unexciting business. The black line is the shares in issue, so that's effectively them doing share buybacks and reducing their share count. I just want you to focus on the green line, which is the share price. And you can see from sort of 19 to 20, that share price was oscillating around $50, not really doing anything, but you can see that they were buying back their own stock. And then for some strange reason, look what happens in January 21. January 21, the share price goes from around $50 at the start of the year to through $400 in a year. And I can absolutely guarantee nothing else happened. There was no bid for the company. There was no massive increase in profits or anything like that. That was just all of a sudden the market sort of waking up and going, wow, look at the number of shares these guys have retired, and look at the way that's impacting EPS and DPS. So, my main takeaways from this presentation, we continue to believe in valuation as a driver of future returns, and using that, we think that US equities look very expensive today. UK equities look very cheap. Therefore, the stronger returns in the future are likely to be in UK equities, not US equities. The really important thing, though, I think today is that we can now see two very clear catalysts that are beginning to realise value for UK equities, and those are corporate takeovers and share buybacks. And I think the final thing that I will leave you with is myself and Nick Purvis, who run this trust. We've been running money for 35 years. And this is pretty much the lowest valuations that we've seen in our time of running money. And that's, again, that should be good news for future returns. There you go, look at that, Annabelle. I've left 10 minutes for questions.
You've done very well.
So thank you very much, and happy to take questions.
Okay, we've got a question right here. This gentleman can't wait. Yep. His hand up, front row. Keep thinking of questions out there.
Here we go. I prepared this as you were talking.
Right.
This is about where companies choose to deploy capital.
Yep.
Our politicians like to say they want more money to be invested in the UK. But if UK companies have bought back so much stock, whether this is financed partly by debt or not,
yep,
what does that say about the opportunity for those companies to genuinely invest their shareholders' money in the UK economy sufficiently profitably?
Yeah.
Are rates of return available to companies for marginal investment within their UK businesses not as attractive as those available overseas? And if so, what might this say about any UK government's growth agenda?
Yeah. Okay, very good question. Most of those companies, I mean, for a start, I completely agree with you in terms of capital allocation. So we always talk about sort of a hierarchy of capital allocation. So when a CEO is looking at how he can invest his money, number one should be pay your debt down. You've got too much debt, pay your debt down. Number two is then investing in the business. And, if you're investing at returns that are higher than a share buyback, you should absolutely be doing that. Now, just to give you an example, that next chart that we looked at, Simon Wolfson basically took Next Directory from nothing to, over 50% of the business throughout that period. And we always say to companies, invest first, so long as the IRRs you're getting off that investment are better than you're getting off a share buyback. And, this is quite a contentious issue at the moment because the returns you're getting off a share buyback are so high because your valuation's so low that the IRR on the investment has to be high. If you see what I mean. So I think, to answer your question, we absolutely are saying to companies, you invest first. Definitely, you should invest first. But with any free cash flow, and by the way, we would never say to a company, go and borrow a load of money to buy back your stock. This is only free cash flow after your capital expenditure. Anything that's left after that, you then buy back your stock. So.
Great. I can see a question over there.
Thank you. Really interesting. Everything you talked about in terms of why there's value was old economy, effectively retail, finance, oil industry. Are you looking at new economy, technology?
No, not really, and which sounds awful, doesn't it? But the reason is because so is everybody else. So, as I said, I was running money in 2000, and today reminds us so much of 2000. There's just such excitement about the potential for AI. And by the way, I won't stand here and say that AI is not going to be great. I'm sure it's going to be great, but so were lots of the things that people were excited about in 2000. The internet, definitely, huge growth thing. It's just that people were so excited about it in 2000 that the valuations were off the scale, and they are today. People are just, Nvidia, 40 times sales. Really? Yes, all right, it might be a great company, but do you really think that paying 40 times sales is a good idea? So. And I suppose the flip side of that, just like in 2000, so nobody wanted to invest in 2000. Nobody wanted to invest in tobacco, mining, and those, of course, were all the sectors that were best performing sectors for the next decade. Partly because they just reached such ridiculously low valuations in 2000, and I think that's sort of what's happening today. So, believe me, we will invest anywhere in the market. So. It always makes people laugh. When we started working at Redwell in 2010, Nick and I used to own Microsoft. Why? Because you could buy Microsoft in 2010 on a P of 8. Because everyone told you that Microsoft was old technology. All the tech guys hated it. So it was on a cash-adjusted P of 8. Today, we're just not interested in buying that sort of stuff. So it is kind of forcing us towards that old economy. But it's not a conscious decision. We just go to where we think the value is.
I love these comments about valuations when the tech managers have just all walked in, and the next session in here is the technology panel. So it could be interesting. You stay in here, you're going to have an interesting conversation. Questions, please. There's a gentleman there.
So I assume that all these businesses are generating a lot of cash.
Yep.
Right? So do you have a certain minimum return on capital employed that you look at as a kind of a cutoff before you invest?
Are you talking about sort of valuation or
no? How? I mean, basically, you are evaluating them on their cash generation.
Oh, yeah. Yes, absolutely. Yeah. So, although quite often we will get accused of, if you're a value manager, you just roam around the market basically looking for junk and you just buy all the junk. I mean, but believe me, that is absolutely not what we do. When we're looking for a company, we absolutely want a company that generates a positive spread on its cost of capital, that it has the ability to grow, that it generates cash, that it's got a strong balance sheet, et cetera, et cetera. It's just that we'll only buy them when they're lowly valued. And the point about that, by the way, is if you think about it, things only normally get lowly valued when there's some sort of controversy around it. Things don't normally get lowly valued when everyone else loves them. Which is, this is the problem I always have with the sort of, I suppose, the quality growth crowd, when everyone loves, Mag 7 and LVMH and et cetera, the idea that you can buy what everyone else loves and you get paid a premium to do that, really? That doesn't feel right to me. Whereas what we're buying is normally stuff that other people doesn't like. And psychologically, it's hard because when you're buying it, you can get given 10 good reasons why, the thing that you're buying is complete junk. But of course, it's only when you've got that controversy that things tend to get cheap.
Okay, the gentleman in the middle there with the glasses. Thanks, Tamara.
Thank you. Appreciate great theoretical backing to the presentation. Really appreciate it. The question really is about for how long growth has actually outperformed value, because in previous decades, value performed relatively well.
Yeah.
But from 2010-ish onwards, it's just been relentless.
Only in the US. So, funnily enough, I saw a very good paper the other day, and it had every market outside of the US, value is beating growth since 2020, which is really interesting. So, whether you look at UK, Europe, Temple Bar, we took over in October 2020. It's up 125% in that period of time. So in most markets, value is beating growth. And you're right. I think we might have a slide in here somewhere. Of the last 11 decades, value beat growth in 9, and growth beat value in 2. The 2 were the 1920s and the 2010s. I would argue there's some similarities between the Roaring '20s and the 2010s in terms of interest rates and rampant asset prices and so on and so forth. But the long run is that value works, and interestingly, outside of the US, value has started working again since 2020.
Great. Question over here, please.
Can you imagine a catalyst for the derating of the US market?
Good question. I suppose the obvious one, I think, is probably rates starting to go up, isn't it? So, at the moment, the US government is just allowed to run this absolutely insane deficit, and the bond market's not throwing a wobbly at the moment. That feels unsustainable to me. And so, and actually, interestingly, whether you get a Trump or a Biden win, doesn't really feel like that's going to change. It feels like they'll continue to run an absolutely massive deficit that will require an awful lot of treasury issuance, and potentially rates go up. I think the other thing potentially is just the delta in the earnings growth. So as the earnings growth slows down in some of those things, maybe people start to look at them. I mean, it's amazing. What people forget is that 2022, wasn't it? A lot of those things halved. So actually, if you look at the sort of 4-year returns on Mag 7, people are often surprised that they're not as good as they would have expected them to be. And it's because they went like that sort of thing. Those would be a couple of things.
Okay, we've got time for one last question. Yep. There's a gentleman right here.
Thank you very much. You've hit upon a raw nerve, as I'm an ex-BP employee and a BP pensioner. One of the things about the oil price, when the oil price is high, then BP makes a lot of money, a lot of cash, and it buys back shares. But at the same time, that's when the share price is at its highest. And so if you look back the last 5 or 6 years, the price that BP has paid for shares are very, very large. About 90% of them, of the purchases, are above today's share price. It's deeply stupid for BP to buy back shares when it has the cash to do it. So can you please discourage them?
Well, we would say, I suppose, we've only got 15 seconds. I mean, as I said, they're trading on a P of 6 times at the moment. So we say that's pretty cheap. The share price is cheap relative to the earnings they're generating at the moment, we would say.
Okay, well, I think Ian has clearly made the point that valuation matters here, and M&A and share buybacks, they're going to be the catalyst for change, he believes. Thank you all for your questions. Thanks to Ian. It's been a very interesting session.